Well, the Westpac Melbourne Institute Index of Consumer Sentiment fell by 1% in December to 104.3. Now that's still above the 100, so we still have more optimists than pessimists. Now, was there any Omicron effect in this result? Well, I think there may have been, because we saw New South Wales and Victoria both fall by 3.5%, and they're the two states that were affected by the lockdowns and by the Delta. Whereas in the other states, they were all up by around 3.5%, and South Australia was up by around 7%. This is really important for us, that this sentiment index stay above 100. Because as I said to you last week, we're expecting 6.4% growth in the Australian economy next year, and that'll be underpinned by a 9.5% lift in consumer spending. And the main reason why we think that can happen is that over the last 6 quarters, the household savings rate has averaged 17%. Now, the average savings rate's around 5%, so that means that over that period, households have accumulated around $250 billion. That money is available to spend, but they'll only spend it if they're feeling confident. So the fact that the sentiment index is holding above 100 is very encouraging. Now, we did see our question, is now a good time to buy a household item, fall by 5%, but we think that's very much due to supply effects, inflation effects, and what I would call saturation effects. And that is because during COVID, people were spent mainly on durables and of course not on services. Next year, the big boom will be in services. One aspect that we found interesting was when we asked them what are the main news items that they recall, usually the main items are around the state of the economy and the labour market, and both of those were relatively strong. But for the first time that I can recall, they registered quite a strong recognition of inflation. A year ago, inflation was getting 5% response. Today it got 21% response. A year ago, 56% were positive. This time, 70% are negative. So this inflation factor is one of the issues that makes us somewhat concerned about the strength of this consumer sentiment story. We also saw that a deterioration in confidence around interest rates, which one would expect given all the talk about rising interest rates in the market. And in that regard, it was interesting to see that is now a good time to buy a dwelling fell by another 9%. That's now down 38% from its peak in November. And what that's telling us is that people are very, very concerned about affordability. So this is really showing up in the finance numbers, where lending to owner-occupiers has slowed dramatically, and it's been the investors that have been moving in. But in that regard, the question about outlook for house prices, it peaked back in April. It's now down by 8%, falling 1.2% again in this survey. So we've also seen the peak in confidence around the outlook for house prices. If we look at it state by state, we notice there have been substantial falls in Victoria, South Australia, Western Australia, less of a fall in New South Wales, and Queensland actually held up. So in Queensland, the house price expectations index is now higher than it was in April, despite the national average being 8% lower. And I think what that is telling us is that it's the first stages of investors starting to be a little more nervous about the housing story. As you may know, we do expect to see momentum going into next year. We're looking at about an 8% rise in the national house price index in the first half of next year, flat in the second half, and then falls to come through as interest rates start to rise. Now, of course, on the 1st of February will be the Reserve Bank's next board meeting. And what was very important in the Governor's statement after the December meeting was that for the first time he did not put a date on the time at when he thinks conditions will be appropriate for raising rates. Up until November, the date was 2024. In November, it was the end of 2023. This time, no date. And one of the reasons behind that was that at the February board meeting, they'll be using new forecasts for inflation. Now on the 25th of January, the whole of the market will be watching the December quarter inflation report. If you recall that in the September quarter, the report was for 0.6 on underlying inflation. Market was expecting 0.4, 0.5, and that shocked the markets. We expect you'll get another 0.6, and that'll mean that inflation for the year of 2021 underlying will be 2.3%. But the Reserve Bank is forecasting 2.25% for 2022. And of course, we're seeing all this anecdotal evidence that price pressures are building. So it's going to be very hard for them to stay with a forecast that says that inflation in 2022 will in fact be a bit lower than 2021. But if they lift their inflation forecast to 2.5, that means they'll be telling us that the conditions for raising interest rates will be achieved at the end of 2022, not the end of 2023. So what they do with their forecasts and how the CPI report prints on the 25th of January will be very important. So markets and dealers will be having their rest over Christmas, but they'll certainly be doing a lot of thinking about this inflation story and how the Reserve Bank may respond to that. It's going to be an incredibly interesting year next year. We're talking about 6.4% growth. We at Westpac think inflation will be up to nearly 3% by the end of next year, and wages growth will be the same, and that'll set the scene for a patient Reserve Bank to raise rates in that first quarter in February 2023. And of course, as we start to see this speculation about these rising rates, so that will weigh on that housing market as we see in the second half of next year those house prices flatten out. So this is the last presentation we'll do for this year, but I hope I've whetted your appetite for what's going to be an incredibly interesting year in 2022. Thank you very much.